with a little bit of live stream. And, well, first of all, I hope you had a good Thanksgiving. It is Saturday right now, and I hope you just have a good weekend. Honestly, wherever you are, I hope you're well. But today, we are going to be looking at a company called EventBrite. Just last night, somebody brought it up to me, and I didn't really have any thoughts on it. I hadn't really looked into it, so I just wanted to take this opportunity to look at it and kind of just go through its documents just so that you can see the things I'm looking for so that you can do this on your own. And this is the S1. So EventBrite went public not too long ago. That means that you need to file an S1. It's just the public document that you need to file if you go, if you're going from private to public. And then it's kind of like an annual report, like a 10K, but with actually a lot more information. So I don't want to waste time, but we'll just get into it. And then I have a little bit of notes right here, so that when I see something interesting, we can just jot it down. So yeah, that's going to be the format for today. Let's get right into it. So first thing we want to understand is the business. Initially, it'll just be some kind of marketing materials, like this is the number of tickets they've issued, number of events. So we obviously know it's some sort of event thing, because there's event in the name as well. But this is a table of contents. So if you wanted to read this whole thing, it'd be 169 pages. And we probably don't want to do that because we'd be here all day. And there's always an opportunity cost for time. So theoretically, we could read all 169 pages, but will each minute that we spend, or each hour in this case, will that benefit us? Sure, we might learn little things about the companies, but we basically, as analysts going through stocks, we have thousands of stocks to look over, and to find the best ones, we need a sort of process in order to make sure that we don't waste time looking at companies just because we found it. We want to be able to look for a company, okay, it's not really that good, move on to the next one. But in this case, I've already kind of screened this, so I think it is a decent company. We just want to be able to dive in to see if it's investable. Okay, so we'll just be reading through this, kind of like the earnings call live stream that we did last time. And so this is kind of the founder's note, it looks like. We founded EventBrite to bring the world together through live experiences. So that sounds like a mission statement. And our business model is simple. We charge creators. So creators are the people putting on the shows or the events. We charge creators on a per ticket basis when an attendee purchases a paid ticket for an event. We grow with creators as they plan, promote, and produce more events and grow in attendance. Okay, so we have the business model. Looks like a transaction fee for the creators. So that's important to know. We'll dig deeper on that. But the business model is important because we need to know how the company makes money before we can assess if it's a valid or sustainable business model. And our platform meets the complex needs of creators. So I've actually used EventBrite before, just for concerts, where you basically just have an app and then you're able to buy or just get the tickets through this app. And it's kind of like StubHub, I guess. But the events I've used EventBrite for were actually all free. So I'm wondering how, it's probably just a lead generation thing, able to get the word out, build that brand, and then whenever people are like, I want to do a paid event, then they use EventBrite as well. But let's dig into it. So more than 95% of creators who use our platform signed up themselves. We derived 54% of net revenue from these creators. 2017 net revenue So revenue growth was 51% last year, which is very solid growth. Our net revenue. Okay, we'll kind of get into the details as we go. That's more of an overview. So this is the market. It's good to know the size of the market just to make sure that this company isn't sitting at saturation, which a company that just IPO'd, it's probably not sitting at saturation because it's a relatively young company in the grand scheme of things. Our opportunity in the top 12 markets is estimated to be 1.1 billion paid tickets, generating 3.2 billion in gross ticket fees. So that would be the size of the market they're going after. So 3.2 billion, which is not a huge total addressable market, quite honestly. If we see that their revenue was 201 million for 2017, then their market share, the revenue divided by the market size, is just 200 divided by 3.2 billion, which is, let me get a calculator out. It's about 200 divided by 3.2 billion. It's about 6% market share. So 6% share for kind of this ticket market. So certainly a long ways to go, definitely not saturated. But it's good to see kind of the market share, how big this company is in the market. So these value propositions, streamlined creator experience. Value proposition is obviously really important because we want to know why this company, like if you're a creator, if you are in a band and you're putting on a show, why would you use EventBrite versus something like Live Nation? I just don't know the industry well enough yet, but we're getting there. But it's just like the value proposition, why use this company over this company. Reduce costs, real time. So none of that except extended creator reach seems like a competitive advantage or a moat. So it seems like the brand is, at least right now, that is the reason for EventBrite having any success. So it's very comprehensive as well. Cost advantages. Creators become aware of EventBrite through word of mouth, exposure from purchasing tickets as attendees, our search engine prominence, a free offering that drives paid adoption. Okay, so that free offering that I was talking about, yeah, exactly. So it's just all about exposure. More than 95% of creators who used our platform in 2017 signed themselves up for EventBrite. So that just means that it's a self-service model and people are just signing on themselves rather than EventBrite needing a direct sales force, going out and meeting with all these creators. See, yep, self-service. So it just lowers the cost of operations if you don't have to hire a direct sales team. And so as an internet business, it's obviously really crowded. I'm sure there's a lot of other ticket-based companies trying to do this, and so we have to get to the bottom of why is EventBrite doing this better than everyone else? Have they been in the game longer? Is their technology better? We just have to kind of figure that out. So this kind of early part is just a little bit of a overview of the company, and it's different with an S1 actually. In a 10K, the business will be at the very top, but so we'll go back to the table of contents. In an S1, the business is actually all the way down here, like halfway through. So let's start with that. So this is kind of the same market, but now we have a little bit of graphics, trends. So consumer preferences shifting to experiences. That's definitely true with the millennial generation, you know. The technology platform. So I don't see technology as a huge differentiator here just because it's kind of just a simple ticket platform. I don't know if that's a real competitive advantage. Like if somebody had $10 million, they could easily probably build the same level of technology. So I don't see that as a huge advantage. I see a lot of just fluff. Okay, here we go. For our free for free events, approach attracted more than 400,000 creators to our platform in 2017. Since 2015, approximately 17% of creators who have produced a free event have gone on to host a paid event. So that's interesting. 17% conversion from free to paid, and then 400,000 free creators. So that's pretty big. Talk about exposure. And they're definitely going through the content route for search engine optimization. So it sounds, there's another company called HubSpot it's a marketing automation and software platform. And when I first was looking into HubSpot, I couldn't really figure out what their competitive advantage was. But they had a whole ton of customers, and they had a really good marketing plan, especially because they are a marketing platform. But it seems kind of similar just in terms of their filings to EventBrite. A lot of soft skills rather than kind of hard data that we're seeing. Like the culture, they're talking more about this stuff, it's interesting because I think the soft skills are ignored by investors, and you can definitely have a competitive advantage made up of soft skills. It just takes continual innovation and continual hard work. So CEO 38. That's awesome. She's young. And that's super interesting. So Kevin Hart's, Julia Hart's. I might have heard of this actually. I think they're the husband-wife team who founded this company. That's really interesting. 10 years age gap. So it's important to look into the management of the company. She worked for Fox. And I wonder about her husband. That's pretty cool if they can. So Zoom is a huge company that got bought by PayPal. Yep. Interesting. So I haven't really even seen much about the straight business. Let's go all the way back up. Like usually the business, I guess it's a fairly easy business model then. Maybe we'll go back to the table of contents. Okay. So here's what I'm kind of confused on. So it says right here, more than 95% of creators who used our platform in 2017 signed themselves up for EventBrite. In 2017, we derived 54% of our net revenue from these creators. So if I'm interpreting that correctly, that means that 5% of the creators who didn't sign themselves up make up 46% of revenue. So if 5% of creators made up 46% of revenue, that would be pretty interesting. It would kind of mean that all these, they're banking on the fact that they get this huge pool, right? They had 400,000 free creators. They have these huge pool of people, and then they're hoping that 5% makes up a huge portion of the revenue. And so I think that's okay. There's this principle called the Pareto principle, and it basically states that 20% of your users or 20% of your customers will make up 80% of your revenue. But it also lends itself to some concentration issues. So if there's a huge, let's say one creator made up 46% of the revenue. If that creator finds a better EventBrite or a better ticket platform, then they might jump ship, and then all of a sudden half the revenue is gone. So that's the risk there. You really need to be careful of looking into that risk, and we will definitely look for that. Okay, so we have a little bit of an idea. We have a transaction fee. We have the fact that the market is not huge, but the company is growing very quickly. And then we have kind of their attack mode. They have a bunch of free creators, and then they're trying to convert. So 17% conversion means that that's about 75,000 paid. If we do 400,000 times 17, 75,000 paid. But then 95% of the paid. Anyway, I'm just trying to do some quick calculations. See, I might have this wrong, but let's just think about it. So 400K times 17% equals, let me get the calculator out, equals 68K. So if it said 95% onboarded themselves, does that mean 68K times 95%? So that's 64.6. So I don't even know if this is correct yet. So it's 64.6K, and that's 54% of revenue. Does that mean then that 68, the 68K minus the 64.6, that would be 3.4K. Does that mean 3.4 or 3,400 creators make up 46% of revenue? And 46% of revenue is, so 201 million. That's 92 million. So 92 million divided by 3,400. So does that mean that those small chunk of what's probably the premium creators, their average revenue is $24,000 or $27,000? So let's just think about that in terms of you're putting on a concert. Those are some big concerts. So here's another calculation. We saw that the market size was 3.2 billion, but the number of tickets sold, I believe it was 1.1 billion. So number of tickets, that's about a $3 fee per ticket. If that makes sense to you guys. So 3.2 billion in fees. This is what EventBrite total times divided by 1.1 billion in tickets. So that's $3 per ticket. Now it would be interesting to look up the average ticket price of like a concert or some event. If it was like $100, then EventBrite's fee is like 3%, which is probably in the ballpark. So if it's 3% on a $100 ticket, let's say, so that 27,000, that's 3%. So in order to get that to 100%, we do 100 divided by 3. So we multiply that by 27K times 33. So this is all just kind of off the top of my head. I don't even know if these calculations are right, but I'm just trying to get a sense of the customer concentration of EventBrite and just thinking about it from a business point of view and how much money based on the market and all these sorts of things. And I think this just comes with time. But that's $800 91,000. So I'm just trying to get a sense of if you're like Bon Jovi or something, right? And you decide to use EventBrite for your ticket platform. It's probably very possible for you to do $1 million a year in concert revenue. I'd say that is very plausible. So 3,400 customers who have annual average ticket sales of $1 million. I'd say that makes sense, right? So anyway, that was a pretty long tangent, and probably pretty confusing. Just email me or something if that is confusing and you want to learn about that. But I was just thinking, basically breaking it down by these few numbers and the market size, just to get an idea of, is it like even plausible that a big creator could do $1 million a year in concert revenue? And I think it makes sense. So let's actually dig into the financials. Well, before that, I want to see what their capitalization. So this is always super confusing to me. When you got warrants and you got debt and you got B shares, A shares. So I should do an in-depth video next time on capitalization structure, because I think it would be too much to get into right now. But let's look into the financials. And I love looking at the management's take on the financials. Okay. So now we're getting somewhere. We charge creators on a per ticket basis when an attendee purchases a paid ticket for an event. We grow with creators. In 2017, we helped more than 700,000 creators issue approximately 203 million tickets across 3 million events. So 203 million tickets, 700K creators. So how many tickets per creator is that? 203 million divided by 700K. So it's like 290 tickets per creator. Okay. So that's super interesting. So 200 million tickets, 203 million tickets, and 201 million in revenue. So it looks like they're getting about $1 per ticket. But their estimate for their market was that they'd get $3 per ticket. So that either means they're lying, which I don't think so, or they haven't utilized, they're basically in an expand mode. They're trying to get as much exposure as possible, and that means low prices, low fees for creators, and then they can eventually have some pricing power. It's actually a really good way to build a business, is offer really, really solid prices and then just raise prices little by little where people won't really even notice as inflation and everything. Like, if you don't have pricing power, your business is toast. Warren Buffett said that's one of the most important characteristics of a business. But that just seems interesting. $1 per ticket versus the $3 per ticket that they estimate is possible in their market. So we should do some digging about that as well. We derive substantially all of our revenue from fees associated with the sale of tickets on our platform, inclusive of payment processing. Okay. Our fee structure typically consists, I can't read today, of a fixed fee and a percentage of the price of each ticket sold by a creator. Okay, so now we are getting somewhere. So back to the business model. So we got a fixed fee plus a percentage of ticket price. Cricket price. Ticket price. So that is the business model. Inclusive of payment processing. Fees associated with the sale of tickets on our platform are gross ticket fees, which we define as the total fees generated from paid ticket sales before adjustments for refunds, credits, and amortization of non-recoupable signing fees. Okay. Those fees with the sale of tickets on our platform are gross ticket fees. Okay, interesting. So now we are getting somewhere. So efficiently acquire customers. We've already been through that. Cost advantage based on, so it's cloud-based, which, okay. Powerful retention. Our success in serving creators is reflected in the retention rate, which was 93% and 97%. So it's good to see that retention going up. So 93% in 2016 to 97% in 2017. So retention is just the number of customers that stayed with your company. So if you were a creator who did a paid event with EventBrite and you did it again the next year, then you would be retained as a customer. So that 97% means 3% of those customers who did one paid event in 2016 did not do one in 2017. Similarly, after making enhancements across our platform, revenue from outside the United States grew from 18% to 30% from 2012 to 2017. So it'd be interesting to see how much in sales they were doing in 2012 so that you could calculate the growth rate of international. So that does seem like a big market, international. The revenue we have generated from creators has increased over time. So this is the gross ticket fee for each creator cohort. So it looks like they do have the pricing power that we're talking about. We see that they were only making $20 of ticket fee per creator, but now they're making $47. So I don't know if this will add up. Let's see, because they're doing it by cohorts, right? And a cohort is simply, it's kind of like a class. So let's say you go to college, your class is all the same year, and if you're in a very competitive school, you like compete essentially. Well, in high school, you could like compete with each other, and then sort of like that. So 2017 cohort would be all the new customers in 2017, and then they'll track that cohort in its next graph, and you'll kind of see this is that 2017 cohort, and it'll just show. See, like this 2013, it started in 2013 and then they've monitored it over time. And it's kind of interesting. The total ticket fees, seems like there's a decent amount of churn here. Like the latest one has really seen an uptick, but these other classes seem to be kind of gradually going down. So in 2017 they acquired a Dutch ticketing company, and then in 2017 they bought Ticketfly. So they bought that company for $201 million. So they probably have some debt on their balance sheet if we're quite honest. So they've made 4 acquisitions in like the past 2 years, which is a lot. They're just trying to consolidate everybody. So this is the breakdown of free versus paid. So 2017 they had 71 million. So now we'll get some more clarity on our hypothesized numbers. 71 million paid tickets. For 201 million. Okay, this makes a lot more sense. This is the discrepancy. So $71 million paid ticket. Sorry, 71 million in paid tickets, but 201 million in revenue. So that means that it is about $3, just a little bit less per ticket, and that lines up with our market size. So it's about $3 per ticket, but then that 132 million is basically a marketing expense. Well, I guess it's not really an expense for them since the platform is scalable. Like, it's no difference if you have 100 events on your platform versus 50. It'll cost you the same because it's just an app, right? So that's interesting. So that's consistent. It's consistent. We just had to dig a little bit deeper. So adjusted EBITDA. EBITDA, there's a bunch of opinions on it, but it means earnings before interest, taxes, depreciation, and amortization. It's basically your operating margin, and then you throw everything back. It's kind of like operating cash flow. You could think of it, but we'll get into that. So the paid tickets, that's a pretty healthy growth rate. Year ended, let's do a little calculation for paid ticket increase. So 71 in 2017, and then 44 2016. And then all we have to do is do 71 minus 44 divided by 44. So that's 61% growth in paid tickets. What's interesting is that revenue only grew 51%. So that means that the growth in terms of dollar amount for the paid tickets is actually a little bit less. So picture this. We have 100 tickets sold, and then the next year we have 160 tickets sold. But for revenue, we have $100 of revenue and then $150 of revenue. So that means that the proportion of tickets to revenue, or revenue per ticket, is actually going down, which is inconsistent with this finding that 2017 was a great number. But that means, I think it is also consistent because the cohorts of 2013, 14, 15, and 16 looks okay, but they're in total going down. So, but the average price is going up. So how do we reconcile these numbers? It just means that the long-term retention is a little bit sketchy. Like if you sign up as a creator in 2013, by the time 4 years later, either you've found a better competitor or the music business is difficult and you've moved on. I don't know what it is. So I don't know the industry well enough, honestly, to understand that dynamic, but it's something we definitely have to keep in mind. So these are some funky numbers. There must be something going on with the acquisitions and stuff. Okay, so now we are getting to some numbers. Net revenue, we saw that it grew 51%, but then let's see the gross profit. So the gross profit, to calculate gross margin, we do the gross profit divided by revenue. Oh my goodness. So 77.8 divided by 133.5. So 58% in 2016. 58% gross margin. A little bit of GM action. And then for 2017, 119.9 divided by 201.6. So 59.5%. So that means gross margins are getting better, but it's still not an incredible gross margin. Operating expenses, let's see how fast they grew. So if we do 153 divided by 112.9, call it, divided by 112.9, operating expenses only grew 35%. So 35% growth in OpEx and 51% growth in revenue. That means that the loss should get smaller, and it is on a relative basis. So if we did the loss from operations as a margin for revenue, we would just do 33, so 33.4 divided by 201, the revenue number, 201.6, and that equals, and remember it's negative, so 33.4 divided by 201.6. So it's negative 16.6. So that's an EBIT margin, loss from operations. That means it's just revenue minus operating expenses, and then we get loss. But in 2016, we had 35 million divided by 133.5. So that's a negative 26%. So that means it got about 9.4%, the margin got 9.4% better. So that's good in terms of a path to profitability. So that's definitely trending in the right direction. And so this is the exact same thing that we just did. Negative 26%, negative 16%, and then these are the gross margin numbers. And then this is as a percent of revenue. It looks like the big benefit for their profitability or getting closer to profitability was kind of a slowdown in sales and marketing. So this is a comparison of the last 6 months. So it's actually okay. The remainder of our paid ticket acquisition. So Ticketfly. Okay. So net revenue from organic paid ticket growth increased by 39%. But 61% is the last 6 months. So about 22% is from the acquisition. And so the thing about acquisitions is they make your numbers look much better for the time being. But let's say this kind of flattens out and you stop recognizing revenue from Ticketfly and it kind of just all consolidated. You could possibly see a kind of revenue take a dip. So that's just something to think about, especially if a company is very acquisitive. So still, after looking at all of this, we see revenue is growing quickly, but we have a big portion of this. Okay, here we go. So organic was 30%. So yeah, it's about 20% is from the acquisition. Oh, here we go. This is interesting. While net revenue and paid tickets increased year over year, net revenue per paid ticket decreased from $3. Remember our magical $3 with all our calculations? in 2016 to 2.84. So yeah, this is interesting. This decrease was driven by our pricing adjustments made in certain markets, which resulted in additional paid ticket volume, as well as an increase in the proportion of lower ticket prices, as our fees are partially based on the price of tickets that creators sell to their events. Lower price tickets. Interesting. So remember we saw that cohort graph, how the average revenue was increasing per ticket, but now we see that on the whole, because of those different cohorts, it's actually decreased. And from $3 to 2.84 is not like a small deal. Let's just do the calculation. Shoot. So 3 minus 2.84 divided by 2.84. So that's a decrease of 5.6%, which in like the grand scheme of things is not huge, but it's also not very small. So their cost of revenue is payment processing costs. So they probably plug into like a back end, like Stripe or some other payment processor, and so they're having to pay all these fees. So that's their cost. So a huge portion of their cost, I assume, is just from having to pay out a good portion of it to these payment processors. And so the leverage I don't really see in the long term, unless these payment process companies get much cheaper, how the gross margin is going to increase that much. So then you're still having to spend a lot on marketing, probably no lower than 25%. So if you did 58 minus 25, that would be like 33% margin. You got some tax rate. I just don't know about the ceiling for profitability, especially as the Ticketfly acquisitions, like all their revenue stops rolling in. It would be interesting to see how this comes. Okay, so now we see the quarterly results, and then if we really wanted to, okay, good, they got the calculations here. So we see over time, we can see some seasonality. So if we directly compare the negative 33% to negative 23%, we see about 10% increase. So it's good to go like year over year. So everything is kind of getting better if we go from June, except that quarter. It could be from the acquisition again. But now we have the EBITDA. So free cash flow. Yeah, we should definitely check out the cash flow statement because it's looking like a strong cash flow number. But I want to see why. I'd like to see why. So stock-based compensation as a percentage of revenue. So 5 million divided by, it's not super bad actually, not bad at all. It's about 5 divided by 67, which is the revenue. So it's about 7% of revenue as stock-based compensation, which the reason you want to look out for stock-based compensation is because there's a dilutive effect. So if you're paying all your employees in stock-based compensation, throw in stock options at them, the overall share count of the company will increase, and then you as a shareholder will actually, over time, own less of the company because it's kind of like the government printing money. It becomes less valuable, and hence there is inflation. It's kind of like a deteriorating effect. So net income. This is some funky numbers. We're going to have to find the cash flow statement. let's see if we can find it. We go back to the table of contents and then go to the financial data. So, that's interesting. They don't really have a full cash flow statement. But the free cash flow is positive. What? That's super interesting. So 2017. I don't get that. Okay, so this is what I don't get. 2017, this is the year end. This is adjusted EBITDA. So they have their net loss. They kind of add back all of their adjustment numbers, and we get 4 million. But then we come down here. How did you jump from 4 million to 29 million? And then I don't get that. We need to figure that out. I don't really even see where the cash flow. My hunch is that it's something having to do with the warrants or just the acquisitions. Net cash. Okay, we'll just read through. The net cash provided by operating activities was 48 million, was due primarily to net loss of 15.6 million with adjustments, stock-based compensation, and here we go. Here we go. Change in fair value of redeemable convertible preferred stock warrant liability. 6.1, an increase of accounts payable to creators of 29.9 million due to increases in paid tickets. An increase in other accrued liabilities of 8.7, decreases in funds receivable, partially offset by a gain on extinguishment of promissory note. Wow. Okay. So what's happening is there's huge accounts payable due to increases in paid tickets. Increase of accounts payable to creators. I quite honestly don't understand that as well. And then another thing is they had 16 million from the extinguishment of the note, basically the interest they borrowed in order to buy Ticketfly. So there's something funky going on with their cash flow, and a lot of it isn't just because the business is doing well. They have these huge accounts payable. So if you're not paying your creators right now, that means that you're not outlaying cash, and therefore that's an increase the accounts payable. So it's interesting that they don't show the full cash flow statement because of that, and they kind of hide it in there. They're like, oh yeah, we have positive free cash flow because we have a great company, but not so fast. I don't like that a whole lot, and it's probably just due to the nature of their business, but like I was saying, I don't know the nature of tickets and kind of like events and concerts as well, since I haven't really looked into one of these companies before. And so that's a very important thing just about circle of competence. So I'm not fooling myself saying I know everything about event management business. It's good to be able to look at a couple of these companies in the same space and see, kind of contrast and get a feel for, how these companies actually function. And right now, as of looking at this company, I don't know the space well enough. I don't know, because that's an important thing. This account's payable. I don't know if the like EventBrite actually pays them afterwards, and so they have a little bit of time, or what. But I don't think the cash flow looks as good as they're trying to make it look. And so yeah, we have gone through a lot of this company. It's kind of a letter from, so they founded in 2006, 12 years later. So that means that the CEO started it when she was 26. That's super interesting. I would be interested to see how much of the company they own, actually. And we can open up the proxy statement to find that. But if they own a lot of it, then it'd probably be a very good sign. Just you want the management to have skin in the game. If they don't have any skin in the game, why should they work nights and weekends in order to make this company work? As an investor, you want everybody, all the incentives to be aligned with what you want, and you obviously want the stock price to go up. Sorry for the scrolling. I know that probably doesn't rest your eyes. So we could be done, and I'll probably do another video, just because it's getting kind of long, on the proxy statement, just so that we can see how to look through a proxy statement, what to look for. But this is essentially how I go through these annual reports. Understanding the business. Is this a good business model? So we know that they charge a fixed fee and then a percentage of the ticket price. We don't know what the fixed fee is. We don't know if it's reasonable versus competitors. We don't know the value proposition at its core. So that's why it's important to look at competitors, to look at the other options out there. Because I know Live Nation is a huge player in this space. So what is the differentiation of EventBrite? Is it the fact that they just got started early, 12 years ago, and now they have the brand, they have 700,000 creators, they have like 68, or how many? It was like 71% or 71,000 paying creators. And so it's interesting. Actually, our original numbers of 68,000 came out to be pretty accurate. And then if 95% onboard themselves, it really does look like this small creator group is making up about half of this company's revenue. And so the fact is that 3,400 is enough of a number so that the concentration isn't crazy. Like if it was 10 creators, then I would be really nervous, because one creator drops off, you see revenue take a huge dive, market tanks on it, like it's just not good. But 3,400 is enough spreading it around that I think that risk is lowered considerably. But then the other question that we have to answer is just thinking about the average ticket price. So we saw that it was going down about 6%, and the cohorts are actually decreasing in terms of the gross ticket revenue. And so why is that? Even though we see retention going up, does that mean that this company doesn't have loyalty over the long term? So just these sorts of questions. Add in another layer about the acquisition, really hyping up the growth. However, we do see the margins getting better because of slowdown in operating expenses, but then the cash flow isn't that great. So there's kind of going back and forth to all of these aspects of the business. and then kind of ranking them based on the companies that you own right now, because there's always an opportunity cost, right? If I decided to invest in EventBrite, then I would have to really test that against the company like my best possible option, right? If I really like Twilio stock right now, if I had the option to buy more Twilio stock or venture out and buy EventBrite, then I'd probably pick Twilio right now, even though it's like my biggest position. And so you just have to think about this opportunity cost, right? So that's another thing to think about. Kind of all in all, I would not invest in EventBrite, and I haven't even looked at the valuation. I'm sure, seeing as that it's growing at 50% because of acquisition, and that it's a recent IPO, I want to guess actually what the market cap is, like the valuation, just to see if the market, just like seeing about my expectations. So based on all of these competitive factors, I would grant it like maybe a 7 times multiple. So if this company is like worth $2 billion, I'm not touching it. So let's check. But also, we didn't count 2018 revenues. So yep, $2 billion. And that's even off of 40. Like, I would never pay $3 billion for this company. I'm surprised that it really got that high. Well, actually, not super surprised. There was some euphoria in the markets. But we see if we would have got in at like 38, it's down about 25%. But then again, so is a lot of stuff. So that's granted 50. If it keeps up this 50% growth, we'll have about 300 million in revenue. So that's 2 billion divided by 300 million. So on a forward basis, yeah, it's about 7. So I wasn't too far off. It's about 6.66, which is the devil number. So don't invest in EventBrite. Just kidding. Just kidding. But right now the valuation, yeah, it's looking about on a forward multiple, which, yeah, it's about 7. So I think the market is valuing this how I would have imagined. So I don't think there's a huge discrepancy in terms of like this is super cheap by any means. And you always have to be wary if something is like very cheap, then either you should know exactly why and then be able to explain why that's not a big deal, or you might be a little bit overconfident the market's actually right. So all in all, after looking at everything, I probably would invest in EventBrite. I think it's an interesting name. I think it's valuable technology, and the fact that they've already like had about 700,000 creators means that they're doing something right. I like that they have young management. I think it could perform well, but just I would not be comfortable putting my own money in it. But that's just kind of my thoughts going through the company, thinking through the dynamics. I'd have to look a lot more into the other companies before I would look seriously at this company. But yeah, thank you so much for joining me, guys. I really appreciate you. Like, if you're watching this whole thing, you're incredible. So yeah, just have a great weekend. Yeah, love you.